So Doug, let's start with what we saw in terms of the quarter. Obviously, it's been a tough year for housing, and when you look at the quarter, it still was down in terms of what housing is looking like.
Right.
Talk about any rebound that you are seeing as we head into 2011.
Well, we did well through the spring of 10, and then in March things slowed down, and most people attributed that to the end of the tax credit. We didn't have a direct, we were not directly influenced by a tax credit because we tend to sell more expensive homes. We don't sell homes to first-timers. So from mid-May until now, things have been choppy. Projecting forward, there's been some better news coming out of the economy. Some of the macro stats have been a little bit better. Consumer confidence is up. Last week it was announced by the NAHB that resale homes were up 10%. So we're cautiously optimistic going into our spring selling season, but right now there's really no trend that we can speak to that shows any immediate improvement. We did announce last week that our deposits were up and our traffic was up about 10% for the prior 4 weeks compared to a year ago, but we're talking about small numbers. So it's really not enough information yet to get too excited about.
Has that continued through December, these first couple of, or week in December?
We had a good week. It's still within the same range as what we've been doing in the past, but I think, you know, our buyers are more sophisticated. They're more tied to the stock market. Confidence of our buyers is extremely important. And I think when there's a good couple of weeks in the stock market, when there's some good news out there, our buyers react to it. And we've been able to track some better sales in weeks when the market has moved or there's been some good news, and that's been true for the last few weeks.
So you talk about that buyer, more of the luxury end. They're not as worried, I guess, maybe about unemployment. They're looking at low interest rates as well. Why do you think they're not jumping off of the sidelines?
I think they're still scared. I think our buyers are very sophisticated, as I mentioned. The unemployment rate of our buyer profile, which is the college grad, is half that of the country's rate, which is encouraging, but that's still up. So, you know, a 5% rate for college grads is still up significantly from where it has been historically. Interest rates are very low, no question about it. Affordability is at an all-time high, but I think the buyers are still waiting. They're on the sidelines because right now there's a lot of volatility in the markets. There's a lot of fear, and we have to get that behind us. There's no question about it, but things appear to be improving a little bit.
When you look at luxury housing, how has it changed in the view of your client? I mean, we talked about McMansions in the past several years. Have you seen that view change?
Not really. You know, whenever we go through a recession, there's a lot of chatter about the McMansion is dead. We like to call it the toll mansion. But the McMansion is dead. Everybody wants a smaller home. That's only because we're in a recession and people are afraid to open their wallets as much. But the American dream is still to own the large home with all the upgrades. You know, through this downturn, we have still sold about 20% upgrades to our standard house in terms of additional rooms and nicer granite and all the, you know, the added features that we offer. We're running at about $110,000 per home in upgrades, and that's through a down cycle. So I think as the economy improves, we believe our buyers are going to come right back out. They're going to still want the big house with all the bells and whistles. And we think that's part of the American dream. So we're very comfortable with what we're offering.
Now you talk about upgrades, but not necessarily incentives. And you said that you're really not interested in doing incentives. Why not?
Well, we do have incentives in place, and it's still a buyer's market, and you still need some incentives in place. What we have said is that we think pricing right now is very inelastic. So if you raise an incentive by $20,000, $30,000, $50,000, that is not driving more buyers. The buyers recognize that the builders have really hit the bottom of their pricing. And right now it's just about other issues for the buyer. Are they comfortable with their job? Are they comfortable with their stock investments? Are they comfortable with their ability to resell their home? Because most of our buyers have a home to sell. So it's not really about price. A couple years ago, it was all about price. And the buyers were coming in and they were demanding $100,000 off and they were demanding $150,000 off. That's different today. I think the buyers recognize the pricing is fabulous. It's a great time to buy a house. Interest rates are low, but they just need to feel better about their own personal situation to step up and buy the home.
When you look at some of the data, it appears that Toll's city developments in particular have been doing better than the other mix.
Yes.
Tell me about the strategy there, and will you make sort of that city development part of a bigger mix in the toll strategy?
Well, we got into the urban world, the city world, about 6 years ago. We branded it Toll Brothers City Living. It's got a whole urban brand to it. We're in Manhattan, we're in Brooklyn, we're in Hoboken and Jersey City. So right now we're just in urban New York City, and it's been fabulous. The New York market has a lot of wealth. We love to hear that Wall Street bonuses are coming out and they're going to be up 5% from last year. We sell a lot of our homes in New York December through March when bonus season hits. We look to expand it. We're looking hard in Washington, D.C. We're looking hard in Boston. Right now it's about 15% of our business. I don't think it ever gets to be more than that, but I think it'll become more diversified with some new cities. Recently, we just announced a great deal on the Upper East Side of New York at 65th and Lex, which will be opening in a few months. We're very opportunistic. A lot of these deals we're doing now are short sales, foreclosures, bank-owned properties, and so we're taking advantage of our balance sheet, the cash we have, and there's been some very, very good opportunistic buys that we've made in New York.
A lot of competition, though, in those markets, in the New Yorks, in the Washingtons.
There is. You have to be careful. You have to have the right location. You have to have the right pricing. There's no question about it. But for the last year, New York urban has been the best market for us by far, and that includes Hoboken, Jersey City, Manhattan, and Brooklyn.
Address some of the markets that people say we're left for dead. Arizona, Las Vegas, some parts of California. What is the strategy in those particular markets? A lot of people say we're not seeing any real comeback there.
Yeah, those markets were too hot. They had too many investors. Maybe they weren't built on the proper fundamentals, and they have suffered the most. There's no question about it. Half our business is Washington, D.C. to Boston. That's been a relatively solid market without a lot of investors, without a lot of huge price appreciation, and so that's coming back stronger. But when you get out west, parts of California, fortunately most of the areas we're not in, like the Inland Empire of Southern California, but Las Vegas, Reno, Phoenix, and parts of Florida, they all got overheated. They all had way too many investors. There's a lot of overhang. A lot of that overhang is foreclosures, and the fundamentals are not in place for those recoveries to occur as quickly as the East. It will take time. Our strategy there is to downsize significantly and just ride it out. There are some opportunities we're looking at where land is incredibly inexpensive that we may take advantage of, but for the most part now, it's to downsize and just ride it out. And it may take a few years.
You mentioned land. I saw a quote that said, you have a flair for land, and really that is your specialty. So discuss the increase in land that you've been on, this buying spree. You added, 3,000 lots this year?
Right.
You plan to spend more on land next year. Why do you acquire so much land now?
Opportunity. We did the same thing in the prior recession of the early 90s. We manage our company very conservatively. We have a great balance sheet. Right now we're sitting on in excess of $1.2 billion of cash, plus we have an $880 million revolver with banks, which gives us over $2 billion of capital to access in these times. Our company has always grown through recessions because we've always taken advantage of the cash we have. We're not afraid of complicated deals. We're not afraid of buying mortgage notes from banks. And right now it's strictly opportunity. We're setting up the next cycle. We're doing it carefully because there's a lot of competition for a lot of deals, which is different from the 90s. But we're seeing some good opportunities, and so 2010 was a growth year for us on the land front. And that's the first time that's occurred in 4 years, and we see that continuing into 11.
So when is the next cycle? Look into the crystal ball.
Well, this started down in September of 2005, right after Hurricane Katrina, and here we sit 5 years later. This will be our 5th spring selling season coming up since the downturn. We sell most of our homes January through April. Fingers crossed, this will be a different spring season. We don't know. Unemployment has to come down. There's no question about it. Consumer confidence has to go up. No question about it. It's beginning to occur, but it still has a long way to go. So I think 2011 will be an improving year, but I think 2012 could be the big year for us.
When you look at the economic cycle, where do you think we are from where you sit when you talk about unemployment has to come down, consumer confidence has to increase?
Right. Well, I think on the housing side, we're pretty sure we hit bottom in March of 2009, which was about 6 months after Lehman Brothers blew up in the fall of '08. Since then, we have seen modest improvement. Now, this past summer, we fell back after the tax credit expired, but I'm pretty sure we're out of the woods. I don't think there's a double dip on the horizon. I think we positioned ourselves in a perfect spot because we tend to compete against the small builders that build the more expensive homes. We've stayed out of the starter home business where all the big nationals tend to compete against each other. So we like our positioning. We're beginning to see improvement in demand. Traffic numbers are beginning to increase a little bit. The quality of the buyer is definitely up. So we're definitely off the bottom, and I would say we're probably off the bottom now for a year to a year and a half. That doesn't mean we're going to roar from here, but I think we will see some steady improvement.
What do you mean the quality of the buyer has improved?
Well, 2 years ago, the buyer would come in and they would tell us that they'd heard from a friend that the decorating of the model was beautiful and they wanted to look at it, or they'd be lost and they'd ask for directions, or maybe they needed a bathroom. Today, the buyer comes in and they talk about how much mortgage they can qualify for and what home site is available because they want woods or they want open backyard, and what model styles, what home designs are available to accommodate their family because they want a playroom on the second floor and they want a master bedroom downstairs. They're asking good questions. They're asking questions that buyers ask as opposed to tire kickers.
So was that housing bubble good for the market?
No, no, it wasn't good for any of us. When
I mean, you have
I had
now
hair.
a better buyer.
I had hair when this started, so no. There's no question the market was overheated. There's no question there was way too much lending occurring to people that should not have been buying homes and should not have been qualified for loans. There's no question about it. There's no questions that all the builders, Toll Brothers included, were in the feeding frenzy, were buying too much land, and took our eye off the ball. There's no question about that. So a bubble, no. There certainly needed to be a change, and that change has occurred in a dramatic way. You know, housing took this country down, and we need housing to bring this country back out. And I think everybody agrees that housing needs to lead us out. So no, it wasn't good, but I think we're okay where we are, and we're very proud of our company and the balance sheet we have. And you know, we were able to break even with our business off 76%. And that's a testament to how we've run our company, how we've downsized it, how we've conservatively managed it. There aren't many industries where you could be off 75% and still be break even.
Now, I know that you're cautiously optimistic about what's coming next year, but when you look at it, there is some fear that housing can have another correction. Prices can dip again, as well as increased foreclosures. Right. So, you know, where does Toll fit into that? I mean, is it sort of this steady ship that you're trying to ride?
We are. As I said, we're taking advantage of great land opportunities now through the distress in the market and through the cash that we have. Half our business is Washington, D.C. to Boston. That's a corridor that's still strong. Land's very hard to find, so when you have it, it tends to be gold, and that's where most of our land holdings are. We're at the upper price range. As I mentioned, our buyer, college grads, have half the unemployment rate as the country, plus households that are making in excess of $100,000. That group is growing 4 times the national average. So, and our buyers are baby boomers. So they're in their 40s and 50s, which means they're in their prime earning years and spending years. So we like our positioning. If there's a double dip, we're going to have to get a little bit smaller. We're going to have to tighten it up a little bit more. We're going to have to be more careful in the land we buy. We don't think it's coming, but we're prepared for it. We'll be able to handle it.
Let's turn to Washington now. I mean, we did see first-time home buyers credit, as you mentioned, some other government intervention in terms of helping with foreclosures. Does the government need to do more to fix housing in your view?
I think right now everyone recognizes that the government will not do a lot more. You know, we had the tax credit. There's a lot of arguments about whether it worked or not. Maybe it just accelerated demand. You know, we had lobbied hard for a tax credit that just applied to new homes. and was more money. And the reason we did that is because President Ford did it in the 70s and it worked because it was a job bill. New homes is what generates the jobs, not only in the construction of the home, but in the landscapers and the decorators and the furniture companies and the home renovators and everybody else. That's where the jobs are, is in new homes. So we had tried to get that through. We've talked about trying again. Right now, we don't think there'll be a lot of traction in Washington for that type of a bill. So I think right now, we're not turning to Washington for any assistance. I think we just need demand to improve naturally, which will occur when unemployment comes down and when confidence is up. So I think Washington can help in terms of unemployment and confidence by making the right decisions fiscally and how the country's run, but I don't think there'll be anything specific to housing.
What do you think some of those right decisions are? The president has been criticized as being anti-business.
Well, he has, and I think that was made clear in early November. I think right now, there's a real debate about what we do to balance this budget or at least reduce the deficit to get the country back on solid ground. We think it would be an incredible mistake if the idea of getting rid of the mortgage interest deduction gained traction. 65% of our country owns a home. And we talk about housing having to bring us out of this. If you slap housing with that, you're going to have a huge impact on the recovery in this country. So that we think is a huge mistake. I think what has to happen right now is the Republicans and the Democrats have to get together. There have to be, some significant legislation passed over the next couple of years. And maybe that's going to happen. We know it appears Obama's already negotiating in terms of the extension of the Bush tax plan. And I think, that's encouraging that there's some cooperation. But I think we have a long way to go. And I think there's a lot of work to be done on a lot of fronts. The biggest is jobs. There has to be help in getting that unemployment rate out of the 9% range. So we'll see what they do.
What's your biggest challenge as CEO at Toll now?
Regrowing the company, returning the company to profitability. We had 7,300 employees in this company in 2005. We had 325 communities open for sale. Today, we have about 2,600 employees and we have 195 communities open for sale. So we need